Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Always good to be here with you on Wednesdays.
So I don't know if you saw on my channel, but this is the first time I've ever had a video edited together. So I didn't do it. Let's be clear. I paid somebody. But Anna, what I did is I was actually forwarded a TikTok video for whatever reason. And it was basically a video of 5 guys bragging about number of units and total assets. And as you and I both know, neither one of those numbers mean anything. I mean, you don't know debt structures and cash flow. Those two numbers are irrelevant. But what I got as I watched it, it's about 30 seconds long, is I started having flashbacks in PTSD to 2006, 7, and 8. So what did I do? I went back to the movie called The Big Short. And
Great movie.
Oh, great movie. I found the exotic dancer scene, which is about a minute long, and cleaned it up. Let's be clear. I cleaned it up and I stitched those 2 videos together, because in that Big Short movie, you hear an exotic dancer talk about having 5 homes, a condo, adjustable rate teaser loans, a first and a second. Their broker saying you could just refi out. And she was oblivious to the situation she put herself in.
Yes.
And that, again, that scene I saw repeated over and over and over in real life. That's why I really mean PTSD. I saw people worth tens of millions of dollars lose everything.
Yes.
And now I see these guys doing it today. Now, clearly it doesn't say it in the TikTok video, but I've been around. These are syndicators. Very likely these aren't their units, right? They're the GP on a pile of stuff. And that attitude just feels so much like 08. So I don't know, maybe I'm just out in left field. What do you think of all that?
No, I agree with you, Michael. You know, there's been, and we see this in every major economic cycle, is before things crash, we have this irrational exuberance is the technical term, right? And it's being so excited about what real estate has done and the economy has done over the last 2 or 3 years that you think, this is so amazing, I can never lose. The economy's humming, it's only going to get better, right? And I saw that in 07 when we started a business, because every business consultant said, the economy is going to keep booming. You can go into all this debt to start a business. It's only going to get better, right? And we believed that because I wasn't at that point a real student of the economy. I knew investments, but I didn't know the economy, right? And here's the thing, most real estate investors don't watch the economic cycles. They just don't. So they're watching real estate, they're laser focused. What's the cash flow today? What do I think I can get in future rents? How do I think I can cut expenses? And let's assume that everything keeps going just like it has. Rates don't change. So when I need a refi, I can refi and get all my money out. Values don't go down. So I can just assume that rents will keep going up. Values will go up when I want to sell. So I don't have to worry about this bridge debt. So the key here is many syndicators and apartments, especially the last year and a half. I'd say 90% of deals that I've looked at, without exaggeration, have used bridge debt. So it's essentially the same as these adjustable rate mortgages that we saw back in 06 and 07, where it's a short-term loan that has to be paid off in 1, 2, 3 years, right? If you get extensions. And if you don't pay them off at that time, guess what? They take your property. Not only do they take your property, but they take the money of all the investors that have invested the money in the property. And so the danger has been that people have done these large deals because they were overpriced, Michael. They couldn't get long-term debt through Fannie and Freddie government financing. If the number doesn't underwrite and the rents that it brings in net don't cover the mortgage plus about 25%, they won't qualify for permanent financing or longer term financing. So in order to buy the property, they have to get this short-term debt. That's what causes this risk. And the irrational exuberance says, okay, no problem. Values are going to go up. Rents are going to go up. We'll have no problem refining or selling. And interest rates are never going to go high again. And the argument is the US government has a lot of debt. They can't afford to pay their own debt with high interest rates, so they'll never do it, right? So this leads people to buy a whole lot of units, right? They can still buy, but they're paying top dollar and they're not de-risking it. They're going into this bridge debt. And so similar to the strippers, back in The Big Short that you're mentioning, they're basically going, this is great. I got all these short-term loans. I'll refi, no problem. When things correct, it's significantly worse than it is for single family home buyers, right? Because with single family homes, your values may come down. Maybe you can't sell. Maybe there's a crash, right? But with multifamily, the value of the property is essentially tied to interest rates. And big brokerage firms that sell lots of real estate will tell you there's not that much correlation between interest rates and the cap rate that determines what properties go for. But historically, there actually really is. There's a lag, but we haven't seen it in the last 12 years, right? So people think it can't happen. So what happens is as interest rates go up with what the Fed is doing, cap rates start to expand. And I've been saying this for a year and a half. And a lot of my friends who are syndicators, I'm like, I can't partner with you because you have bridge debt. I won't do it. I think we're heading for inflation, right? And now we're seeing that even though one of the big brokers, I'll just say who it is, Marcus and Millichap, just a few months ago said, hey, everyone, keep buying multifamily. It's really resilient and the cap rates aren't going to expand very much. Guess what's happening in apartments right now, Michael? The most recent reports for May and June are that cap rates are starting to expand, especially in older buildings and secondary markets. So what that means is if you have a lot of bridge debt and suddenly the cap rate goes up, meaning the returns required from investors are higher, so they're going to pay less for your property, and now they have to borrow at much higher interest rates too. The only thing that can happen to adjust that is that values come down. So all these people that syndicated deals, maybe here's a secret, a 1% owner of that GP or a 2% owner of that GP or of that deal. They will say they have 500 million assets under management, but they may have only raised $1 million of capital and have nothing to do with the operations of that deal day to day. And they're claiming they own all these units and have all this assets under management when their piece of the pie is so small. They're not cash flowing until the end. And hear me on this. Most large multifamily syndicators, of which I am one, do not make much cash flow at all during the hold period. You're rewarded on the front end with the fee and on the back end if you do well. And so if these things don't do well, the syndicators aren't out much, right? But the investors that are in those deals, they could be left not seeing their money back. And so it's a risky gamble. And it's why I've done very few deals over the last year and a half that are large multifamily. I've done 3, right? And they were good risk adjusted deals, but it can be very, very risky. I see it all the time. Do not be lured into putting your investment dollars with someone that claims a certain number of units and a certain number of dollars assets under management, because that doesn't tell the whole story. You need to find out, are they using bridge debt? How many of their deals have bridge debt? And how long have they been doing it? Have they lived through a previous economic cycle and how did they do? And if you don't have a really good track record and they're not telling you that they're making all these risk mitigation moves, like, assuming that rates go up when they have to sell, that they can't get top dollar rents, you don't want to place your money there.
Yeah. Again, the attitude that I saw in those 2 videos, I'm going to put the link, probably it's comment number 1 so people can watch it, but it's the same. Basically, it was an attitude of can't do any wrong, dangerous, bad debt structure, dangerous. And again, talking about numbers that don't matter. I don't care if you have 200 units or 4,500 units. First off, saying you have that is in many cases a bold-faced lie. You may have 1% of that. You may have 45 units.
Right. And that's why I'm always careful. I actually did a post on this that ruffled some feathers about a year ago. I'm always very careful to say I have ownership in this number of units. I have ownership in. I don't own those, right? My own personal portfolio, I've had, generally speaking, about 100 units from any given time, depending on what I'm buying and selling. And I have a joint venture of almost 300 units. So my own deals that I really own or own a big piece of is a few hundred, right? But I've done and had ownership in thousands of units, right? That doesn't mean I own that. And so just be careful with that. You need to dig a little deeper. The other thing is, Yes, I've made some really smart moves and some smart investments, and I've been rewarded handsomely for that. But I cannot but say that the fact that rates were so low for so long allowed me to grow substantially. And we had apartment complexes, Michael, that we bought 2 years ago before the pandemic, maybe 2.5 years ago, that we were only halfway into our value add, updating the units to really force those values. But because values skyrocketed, we didn't have to do all the work that we were supposed to have to do to return our investors the top dollar. So we sold, looked like rock stars before we even finished our deal. Now, yes, we managed through a pandemic. We worked really hard to get us out of that and still profit. But part of it was the market that helped us be so successful. So I'm not super impressed when someone who's been doing this 3, 4, 5 years has made double-digit returns for their investors on the sales that they've sold in the last year and a half.
Exactly.
It doesn't mean that they can repeat the same thing in the future when values potentially could be coming down because of what's happening with cap rates and with interest rates. Now, again, there are great syndicators out there that have been in this business for a long time that I'm actually still investing some of my passive money with, but it's few and far between. You've got to know them. You've got to know the markets. You've got to know if rents can keep going up, supply and demand, and you better make sure they have fixed debt. So I'm not poo-pooing syndication. I'll still do it when the deal is right. But the level of risk that's out there and the kind of attitude of I can't lose, so let's just keep doing more with bridge debt, that's really the dangerous piece that you have to look out for.
Yeah. And then the last thing that really just made me feel icky as I was watching these video is knowing is if these individuals, if they get it wrong, I don't know these guys from Adam. I don't know any of them, but if they get it wrong, they don't lose. They already got paid up front. They got their money up front. They may lose some back end, but it's not their money. It's not their money. And that just makes me feel terrible for what might come to lots of limited partners in the very near future.
Yeah. And there's some nuances to that, right? I mean, most of us, when we do large apartment buildings, even though it's supposed to be non-recourse debt, we are signing a bad boy carve out. And in that bad boy carve out, it basically says, if you do any of these things wrong, we can go after you personally if you fail, if we have to take the property. A lot of people say that it's non-recourse, but it's really not. One of the clauses in the bad boy carve out is if you miss a mortgage payment, right? Ooh. So you miss a mortgage payment, Anna is no longer free and clear and gives the property back and lets my investors lose. My investors may lose if they take it back, but they can go after me personally. So there is some level of personal risk. Don't think that there's not. But yes, it could harm them, but it can harm a lot of other people.
Yeah. So Anna, where can people find you? Because you put out amazing stuff and you are a very conservative investor, which I love to see.
Great. Thank you so much. You can find me here. You can find me on my playlist. You can find me at Anna Kelly, REI Mom on social media. And my website is reimom.com.
Thank you so much. Thanks, Anna.
Thank you.